So we're going to start just with a summary of where we're at year to date in the middle of June here. The S&P is doing very well. We're up about 14.1% year to date, albeit the bond market overall is showing it's still down about 1%. The equity markets continue to show very strong growth, even though the economy is slowing, and the anticipated Fed interest rate cuts that we expected to happen in the middle of this year have been postponed and possibly may not even happen this year.
Yeah, it's kind of like a countdown. 4, 3, 2, 1. Well, that's where they're at right now.
Yep. So we shall see. The economy is moving along pretty good. Inflation is not as low as the Fed wants it. So we're having that to deal with, and thus they're reluctant to start lowering interest rates. When we talk about the bond markets, they have been improving, but they continue to lag in performance. And again, it's due to the delay in the Fed rate cuts. We kind of expected to see more of a resurgence and get back to a return of normal in the bonds. But as long as rates stay high, that has held off. We do, however, expect once the Fed starts cutting rates to see some of these longer duration bonds and fixed income investments take hold and give us a pretty good 3 to 5 year return moving forward. When we kind of look at the economy by sector, where do we see the growth? Now, this is all sectors and all stocks. This is not just the S&P 500, so the numbers look a little different. The all-sector return is 10.94% year-to-date. Technology, obviously, is still leading year-to-date, up 24%. Financial services are doing well. Healthcare, but you can see the numbers have dropped off a little bit going into consumer cyclical. However, that's a decent rate of return, 2.79% for consumer cyclical stocks. Communication services is having a great year. Industrials, a decent year. Consumer defense, energy, basic materials, and utilities are doing well. The only negative really is the real estate market. And that's primarily the commercial real estate. We're still seeing that lagging. And again, commercial real estate is highly leveraged due to how they take loans out against those properties. Those are kind of lagging, and we can see that continuing into next year as these companies tend to have to refinance every 3 to 5 years. So the fact that they're refinancing at higher rates, it's creating a real lag in those real estate investments. So let's talk a little bit about where the economy is at year to date. On the left side, you can see our June economic speedometers. We're showing still a fairly good, strong economic forecast for the next 6 to 9 months. When you look back on the right side to where we were at in January, you can see that there was nothing green, nothing positive. Right now in June, we're still seeing positive movement in the economy, even though it is slowing. When you look on the left side of the chart, the third line under International Economic Outlook, you can see that there's a lighter grade shaded needle and the darker black needle. What that means is that the lighter shade was where it was about a month ago. So International Economic Outlook actually is improving. That's a good thing for us to consider when we're looking at portfolio allocation going into next year. And so that's something we're watching as your advisors when we're managing the portfolios, and just wanted to point that out. But overall, we're seeing good economic signals, indications that the next 6 to 9 months of the economy is still chugging along and doing very well.